The S&P 500 closed at a record 7,520 on Wednesday, up a fraction of a point, while the story underneath the index was almost entirely about one filing. SpaceX published its S1 last week, and the ripple effects hit the session hard, but not where most investors were looking. Redwire surged 31%, AST SpaceMobile jumped 20%, Firefly Aerospace rose 21%. These are small-cap names that retail investors can actually buy today, and the flow into them was fast and front-loaded, concentrated in Tuesday and Wednesday before any institutional allocation window opens for the IPO itself. The S1's headline number, a $2 trillion target valuation and $75 billion raise, was already known from Reuters sourcing. What was not fully priced before Wednesday was what the filing disclosed about the web of commercial relationships connecting SpaceX to the rest of Musk's empire. Tesla has sold $890 million in vehicles and batteries to SpaceX and XAI since 2023. Megapack battery sales to XAI alone totaled $506 million in 2025. Anthropic is paying SpaceX $1.25 billion per month through May 2029 for access to the Colossus supercomputing facility, roughly $15 billion in committed compute revenue. These are not projections. These are disclosed counterparty obligations now on the public record. The Iran peace signal added texture to the session without changing its spine. Bloomberg Markets reported muted equity reaction despite Brent crude holding above $103 a barrel, as traders assessed conflicting ceasefire signals from Washington and Tehran over the Strait of Hormuz. Oil stickiness held energy sector positioning in place, but for the broad market, the SpaceX disclosure was the actual center of gravity. The question the session left open is whether the capital moving into space proxies today understood what the S1 also contained, because the filing's most consequential line may not have been a revenue figure.
On the same day retail capital poured into space proxy stocks, the FAA ordered SpaceX to investigate why the Starship V3 Super Heavy booster failed during its test flight on May 22. The booster was supposed to complete a controlled burn and land in the Gulf of Mexico. Instead, it experienced what SpaceX called a hard splashdown, an engine failure mid-descent. The FAA classified it as a mishap, grounded Starship until the investigation is complete, and stated it will oversee every step of the review before approving SpaceX's corrective action report. The unstated premise driving the 20 to 31% surges in space proxy names is that SpaceX's operational track record, Falcon 9's reliability, Starship's recent progress, supports the $2 trillion valuation floor. Bulls in the IPO allocation conversation treat the FAA investigation as procedural, the standard post-anomaly review that SpaceX has navigated before. The competing frame, surfaced in the same S1, is that Starship is not a peripheral system. SpaceX has spent more than $15 billion developing it. The next-generation Starlink satellites, the ones that improve per-unit economics and underpin the $11.4 billion connectivity revenue figure, require Starship's larger payload capacity to launch. Starlink had 10.3 million subscribers as of March 31, up from 5 million a year prior, but the unit economics of the next generation depend on a rocket that is now grounded. The S1 is built on Starlink's existing $4.4 billion operating income. A grounding that delays next-gen satellite deployment does not threaten 2026 revenue in any observable way. The current constellation continues operating. What it threatens is the premise that Starlink's subscriber growth rate, which doubled in 12 months, can sustain itself at current economics while SpaceX waits for Starship clearance. The market is pricing the IPO on the S1's demonstrated financials. The FAA order puts the operational foundation of the growth case, not the current number, but the path to the next one, into a window of regulatory uncertainty that the filing itself cannot resolve.
The question the FAA order raises connects directly to the assets that are now on the table for existing public market holders. TSLA's position is the more immediate one. Tesla's $890 million in cross-revenue with SpaceX and AI is not equity. It is disclosed commercial dealing at MSRP terms per the S1's related party language. But Tesla also holds an equity stake in SpaceX, and if SpaceX lists near $1.5 to $2 trillion, that stake crystallizes on Tesla balance sheet as a publicly marked asset. Holders who bought TSLA as an EV or AI infrastructure name now find themselves exposed to SpaceX's valuation trajectory in a way the stock never previously disclosed at this level of granularity. Google's exposure is a different order of magnitude. Alphabet invested $900 million in SpaceX in 2015 at a roughly $12 billion valuation. By Q1 2025, Alphabet disclosed approximately $8 billion in unrealized gains on the position, already a quarter of a single quarter's net income. At a $1.5 trillion IPO valuation, Alphabet stake could approach $110 billion. That number has not moved into mainstream Google valuation discussion at scale. Institutions that own Google as an advertising and AI platform name are sitting on an embedded position in the largest IPO ever filed, and the FAA investigation is now a variable in how quickly that embedded position reprices. The timing asymmetry visible in the session data is this. Retail capital entered space proxy names on Tuesday and Wednesday in front of any institutional IPO allocation. Institutional holders of TSLA and Google have not yet confirmed a repricing move linked to the SpaceX cross-ownership disclosures. The IPO window is targeting mid-June, which means the next 4 sessions are the period in which institutional positioning in those two names either adjusts or does not. If Starship's investigation extends, the FAA has set no timeline. The operational confidence that underpins the $2 trillion figure faces a verification gap exactly when allocation decisions are being made. The lean here is that Google's balance sheet exposure is structurally underpriced relative to TSLA, which has received more coverage. But the condition that tips that lean is whether the FAA clears Starship before the IPO roadshow pricing date. If clearance comes early, the embedded asset repricing in Google accelerates, and TSLA's cross-revenue disclosure becomes secondary. If the grounding extends past June 12, the question becomes whether a $2 trillion valuation survives its own S1's operational dependencies, and who among TSLA and Google holders actually needed to reposition before that answer arrived. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.